Oh, hi, Hunter. You're mute, Hunter. Can't hear you. Hello? Give me a moment here, Hunter. Just need to get into the file quickly.
Okay.
Oh, I hear you now. Good morning.
Good morning.
Come on. Oh, there we go. All right. Okay, just you and me so far, huh?
Yeah, it looks like it.
Do you want to show your face, or are you gonna remain in?
I'm currently on my desktop. It doesn't have a webcam.
That's okay. That's okay.
Yeah.
Some of the students wish that my face wouldn't be shown either. So, you're in my 110 class, right? That's why you're here, correct?
Yeah.
Okay. Since I never meet anybody, I don't know all the names off the top of my head. But you've been doing pretty well in this class, I believe, right?
Yeah, I just took the midterm for the class.
Yeah. How'd you do on that?
I did all right. Could have done better. Just something to keep in mind.
Yeah. Okay, we'll get going in a moment here. Just let me move you over to my private office, okay? Which is another way of saying the other side of the room. Okay. All right. Okay, Hunter, let's go. Oh, Rod's showing up. Hi, Rod. Hello, Rod. Can you hear me out there in television land? We chased Rod away. Okay, I'm going to share the screen with you, okay, Hunter?
All right.
Are you a local guy, Hunter, from around here?
No, I'm not actually. I'm currently in Bellevue, Washington.
Bellevue, Washington.
Yep.
My goodness. You know what they say about that town? It's better than being in Bellevue, New York. Do you know what Bellevue, New York is?
I don't think I do actually. No.
It's probably one of the world's most famous insane asylums.
Oh joy.
Okay. All right, Hunter, we're going to go through chapter 11. Did you get a chance to look at the chapter 10 video or get a chance to do some of that homework?
Not quite yet. No. I've been reading the book.
Okay.
Yeah, but besides that, I'm just actually going to work on that today.
Yeah, chapter 10 and chapter 11 are almost mirrors of each other, okay?
Okay.
In chapter 10, we went into the selling side of things, okay? Oh, hi, Rodrigo. How you doing? Can you hear me, Rodrigo?
Yeah, good morning.
Good morning. Hunter's with us. Hunter, Rodrigo. Yeah.
Morning.
Rodrigo, you came in at a good time. Hunter and I waited a few minutes for people. Chapter 11, I was just saying, Rodrigo, is a mirror to some extent of chapter 10. In chapter 10, Hunter, we talked about selling and we talked about the amount of sales that you bill out. We can call those gross sales. And then you reduce your sales with sales discounts, sales returns and allowances, and credit card fees. Those are contra revenue accounts, which will reduce your gross sales to net sales. You never debit sales. Never debit sales. And you're going to hear me say that throughout the course. What you do with sales, though, is you've got to debit the contra revenue accounts, sales discounts, sales returns and allowances, credit card fees. Then we come down to what we call net sales. All contra accounts are married to somebody. In the case of sales discounts, sales returns, allowances, and credit card fees, they are married to your sales, which we never debit. Now in chapter 11, we're putting ourselves on the purchasing side. So what was a sales discount in chapter 10 is now a purchase discount or a purchase returns and allowance, okay? And let's take a look here. Define merchandise purchase transactions, huh? Merchandise acquired for resale. I believe we all know that. It's the very definition of merchandise. You buy it low and sell it high. And procedures vary, depends on the company. And sales and purchases can be done in cash, of course, or on account, meaning accounts payable. And the former is what we're going to talk about here. We're going to be talking about sales, purchases on account for the most part, okay? I'm going to go through these forms, not that they're terribly important, but I think you might see 2 points or so on your test, just knowing these different forms, and they're not difficult. I mean, I worked for many years, and we use these things like crazy. Under the world of new computers now, maybe a lot of this can be done online. You can type these things out and electronically move them along. But you work in your business, Hunter, and you decide you need a new computer, but you're not the purchasing person and you don't have the authority to just pick up the phone and call for a new computer. So what you are allowed to do is fill out a request form called a purchase requisition. And all it is a form or even just a note or a text or email these days to the purchasing department, where you go to your boss, rather. You go to your boss, you fill out the requisition, you say, I need a new computer, boss. I say, yes, you do. I approve it. Then it goes to the purchasing department, because we don't want you buying your own computer. We want all the purchasing centralized. So they buy it. And then when the stuff arrives, it comes back, you fill out a receiving report and you get an invoice maybe in the mail. And all of these 4 items could be stapled to your journal entry. So you have a nice clear story for the auditor. Purchase requisition, it's just a request. These things don't have to be pre-numbered or anything, and they can be prepared by almost anybody. It's a wish list. And they're talking about sending it to purchasing, accounting. We're not going to worry about that. Purchase requisition. And there's an example of it. Guy wants to buy a couple of Taprite levers, huh? Oh boy, that must be a funny company. Purchase orders. Now here we're getting into something that's along the lines of a contract, huh? Purchase order. This is a written order to buy something from a specific vendor. You call up the vendor and you say, I want to buy 100 barrels of polyester resin from you. And he says, okay, what's your purchase order number? You give him a purchase order number. At that point, you have a contract. You can't back out of that unless the other guy says it's okay. So the purchasing department reviews the requisitions and they would create the purchase order. No accounting entries on requisitions or purchase orders. This is all on the front end. And there's your purchase order, which looks just like the requisition, I guess. The receiver, the computer's going to come into your shipping or warehouse area, and there's somebody is going to open up the box, take a look at it, make sure it's right, and mark off that he received it and how many. And the invoice, we all know what an invoice is. It's a bill. You get the invoice in the mail from the electric company. It's a bill prepared by the seller, and the accounting department has to do a few things with it. And like I said, the accounting department might take all the copies of all the forms, the requisition, the purchase order, the receiver, staple them to the journal entry and file them away like that, okay? Checking all documents is an example of internal control. And I don't know if things have changed in the last few years, but in the old days, you would sometimes find pretty glaring errors on what appeared to be a typed invoice. You bought 3 items for $10, and instead of 3 times 10 is 30, it was 3 times 10 equals 300 by mistake. And if you didn't physically do the math, you could get stiffed like that. And an invoice, okay? Okay, now let's get into the world of where we actually do some, financial analysis here. Cash discounts. It's a discount offered by the seller to the buyer to entice the buyer to pay early, okay? you're willing to give maybe a 210 net 30 discount, and you're willing to give up $2 if this guy pays you 98 right now to settle his $100 bill. The buyer calls it a purchase discount. That's chapter 11, what we're doing now. Chapter 10 was the seller. It's a sales discount. One man's sales discount is another man's purchase discount. Trade discounts. Now, these are not accounting related at all, but don't be confused by it. The cash discount is a very specific agreement to provide a discount for those who pay early. A trade discount is typically offered by wholesalers, and they'll show a reduced price in their catalog. Typically, you might look through their catalog and you want to buy something, and right on the top of each page it says 40% off on everything. That's called a trade discount. It is not recorded in the accounting records. Should not be entered in the accounts of either the seller or the buyer or the general ledger. Same thing, you walk into a store and you've been planning to buy a $1,000 computer, and you walk in and lo and behold, there's a big sign, 30% off. That computer is now only $700. That's what you record, the $700, okay? No trade discount is required to be recorded. Let me say that more clearly without goofy language. You don't record a trade discount on the general ledger. And here is an invoice. Describe and use merchandise purchase account and compute gross profit. Okay. We have purchases. We are still working under the periodic inventory system, which means that when we buy something, we debit to an account called purchases. Notice we don't debit inventory. The reason we don't debit this inventory to inventory is because we don't record the cost of sales nor the reduction in the inventory at the time of the sale. We just record the sale or the purchase. At the end of the period, both the seller and the buyer have to go out and count the physical inventory in order to compute the cost of goods sold. Okay, so just like I keep saying, you never debit sales, you never credit purchases. You never credit purchases, but you do credit their two contra accounts, purchase returns and allowances and purchase discounts, which reduce your purchases to net purchases. And if there's any freight in, you add the freight into the purchase. The freight in is considered part of the merchandise. Freight in means the cost to bring the goods to your factory on the truck or a delivery wagon or however it was done, the UPS charge, etc. So let's just take a look here real quick. Let me blow this up. Blow it up. Okay. Under owner's equity, we know now that owner's equity at the end of the period is updated with the revenues and expenses. In other words, the profit we know zeroes out to owner's equity. So does drawing. And now we're introducing some new expenses and contra accounts for you. Purchases, that's going to be an expense, debit balance, right? Normal debit balance. Purchase returns and allowances, they have a credit balance. So Rodrigo, when you start doing the homework for this chapter, you're going to be tempted to say, well, sales discounts was a debit. These might be too. Now, it's just the opposite. Purchase returns and allowances, purchase discounts are contra purchase accounts. Purchases is a cost. It is an expense. Purchases is a cost. And notice the freight in with the debit balance. That you would add to your net purchases because that's part of the cost of the product you're buying. Purchases account, what is it? We record the cost of the merchandise purchased. It's debited when merchandise is purchased. And guess what? You never credit it. You never credit it, never. I mean, they're talking about the closing process. Well, we know that. But other than the closing, we do not ever credit purchases, just like you never debit sales. And here's an example of a purchase. Let me know if you can't read the numbers. I figure if I can read them, you can read them. Here's an example of a purchase made on account, huh? We debit purchases and we credit accounts payable. Good gosh, who knew, huh? So that's not too tough to get started. Now we have a return. A customer returned something to us. Excuse me, mind if I have a quick snort of my whiskey here? I just need to clear my throat. Oh, that's good whiskey. Contra account is used to record purchase returns and purchase allowances. Credit balance on those, the opposite of the sales discounts in the sales returns. They're credited for the amount of the returns and allowances, and you never debit these. Never debit them, never, excluding the closing process. So let's see what we have here. We had a return from we are the buyer. We returned $200 worth of material because it was defective. And what we probably did was call the seller and say, I'm going to bring this back, okay? Just letting you know. And he probably said, that's fine. I'll even give you a debit memo number if you like, or a credit memo number. Not necessarily required. So the entry is pretty simple. We're going to debit accounts payable, but we're not going to credit purchases. We're going to credit purchase returns and allowances. Because a company, just like with the sales, you want to know how much did you actually bill out to customers? And then how much came back to you in the form of sales discounts, receipts? You want to be able to track that. Same thing with purchases. You want to know how you're doing taking purchase returns and allowances and purchase discounts. Assume the same merchandise is retained, but the supplier grants a reduction of $45. In other words, here it's a $200 item. We called the guy up and said, we're going to return this, okay? He said, yeah, no problem, bring it back. Here we called the guy, and this time the supplier said, look, I don't want it back, okay? I don't want that thing back. How about I give you a price reduction of $45? Would that work for you? And we might say, okay, that's good. We'll keep it and save another $45. Again, that's a purchase allowance. That's an example of a purchase allowance. So again, we debit accounts payable because we have settled that amount by getting that discount. And then we'll pay $155 or less if we take the discount. Purchases discount. A contra purchase account, like we've been saying, used to record cash discounts allowed on purchases. Sales discount and a purchase discount are exactly the same thing, depending on what side of the equation you are. We're the purchasing side, so we're calling it a purchase discount. And this account is credited for any discounts granted by the vendor for prompt payment, okay? You might be saying to yourself, why don't we call that $45 from here a purchase discount? Well, the reason you can't is that it was not a cash discount. It was not a cash discount. You're still going to have to pay the full invoice, which is now $155. The 200 minus the 45. Okay. And again, you never debit the purchase discounts. Merchandise is purchased for $100 on account with credit terms 210 net 30, and payment is made within the discount period. 210 net 30, 2% discount if you pay in 10 days, otherwise you pay the net in 30. 210 net 30, 2% if you pay in 10 days, net means everything. You pay everything in 30 days if you don't get the money in before the discount period. So this customer, we owe this vendor, we owe this person $100. And we paid it well within the discount period, they're telling us. So We no longer owe him $100. We owe him $0. So that's why we debit accounts payable to get rid of that credit balance. But we only had to pay $98 because we took the 2% discount. And I believe your book tells you, which I'm going to tell you again, a 2% discount, a 210 net 30 discount, you would be nuts not to take that, because that's equal to about 37.5% a year. If somebody's willing to give you a $2 discount, basically every 20 days, the difference between the 30 days and the 10 days that you're actually going to come up with the money, that's a good deal. Freight in, adjunct, they're calling it an adjunct purchases account. Okay. It's just an addition to your purchases, but we're going to call it what it is, freight in. This is the trucking cost to bring the goods in, the UPS fee. And they're calling it an adjunct purchase account used to record transportation on inbound merchandise purchases. We debit this account for transportation charges. Let's have a little fun with FOB. I like going over this because I find this interesting. FOB, free on board. I call it freight on board all these years, and I guess I was wrong, but freight on board, we used to call it free on board. FOB simply means the point in time when ownership of the goods changes from the seller to the buyer. So drink that in. Free on board is the exact point in time when title passes from the seller to the buyer. And that is a very, very important consideration in terms of purchasing. Companies use these strategically for various reasons that I'm going to speak about shortly. In our book, we're going to talk about FOB shipping point, FOB destination. FOB shipping point. We just bought something from a company, and it was FOB shipping point. That means as soon as their truck drove out of their factory, we now own those goods, even though we may not get them for another week or two. We own those goods. And that truck is going all the way across the country from Santa Barbara to my old hometown of Newark, New Jersey. And if that truck has an accident anytime before getting to my place in Jersey, we, the buyer, we're responsible for the freight. We're responsible for insuring it. We're responsible for every cost involved if it's FOB shipping point. Freight charges, excuse me, please. Freight charges can be on the invoice, or you get them as a separate freight bill. That's kind of irrelevant to what we're talking about here. FOB shipping point. You call me up and you say, okay, I want to buy this stuff, and I say to you, I'm going to ship it FOB shipping point. You might say, okay. I like to ship it FOB shipping point because once it's out of my store, out of my factory, I don't have to worry about it anymore. But you tell that to your customer, and the customer says, no, I don't want FOB shipping point. That's a pain in the neck. He said, I don't want to have any responsibility for this stuff till I get it. So you make a deal, it's going to be free on board destination. So that truckload of goods, which just left our campus on its way to Newark, New Jersey, if that thing falls into the Hudson River, the seller is now the one responsible for it, because title did not change or will not change until the goods arrive at the destination. Okay. Now, that doesn't mean that they're saying here the seller pays for transportation. Well, that's not necessarily true. I mean, yeah, the seller's going to pay it, but then they're going to bill you for it, most likely. Okay. Here's an example with freight. We bought $400 worth of goods. I was going to say we bought $400 of goods for $400. We bought $400 worth of goods, and they tacked a freight charge on it. We got the invoice, and the invoice says, here's your $400, and here's the freight. Okay. In this example, the seller paid the freight, And now he's asking us to reimburse him. So that's not too tough, guys, huh? You have a debit to purchases and a credit to freight in, okay? Oh, hi, Ali. I didn't see you sitting there. Welcome aboard. How long you been sitting there, Ali?
Good morning. I've been here for I think like 15 minutes.
Okay, nice to have you, Ali.
Thank you.
Okay, so that's not too tough, huh? We purchased something, $400. They put the freight on the invoice, makes it easy for everybody. I'm just going to talk real quick about FOB a little more. Where I worked for a while, we had trouble paying the payroll. We had no money to pay the payroll. So what I could do once in a while, I could call the oil supplier in Bartlesville, Oklahoma, and I would say, could you please put a freight load of goods on the railroad track to us, and please make sure it's FOB shipping point. And the reason for that was I could borrow against that money, because as soon as they put that on the railway on the spur, I own that material. I could put it into my inventory, and we were allowed to borrow 90% against the inventory. Hello, Professor Alsheimer. How are you? This is my boss.
I just wanted to check in if I really messed it up this morning.
Oh, how so? What were you worried about?
Oh, I sent an email out and a reminder about the homework and the tutoring and the lecture, and I put it in lecture at noon.
Oh, okay. Well, this proves
Because
nobody.
I did too much copy and pasting. This is what happens.
Well,
I was
welcome
going to ask you
aboard.
about that because I logged in just in case to see if the class was going on,
Yeah.
and it was. I'm like, wait, I wonder what that email was about.
Okay, well, I can
I
go
know.
in at 12. I'll go in at 12 o'clock again, Cornelia, just to see if anybody shows up.
Yeah, that would be great. I also send out like at 9:55, I send out a second correction, 10 a.m.
I do that a lot. Now we're good here.
so
We've got Rodrigo,
Okay.
Arthur, Ellie.
Right. Right.
All right.
I'm currently sitting and responding and grading your discussion posts.
Okay. Are you going to stick
Almost
around with
done,
us?
Right? 4 more weeks and we have it. 4 more weeks and we're done.
It's amazing, isn't it?
Yeah,
Right?
quick.
Goes quick. I think May 7th or so.
Yeah. And Governor Newsom says we might open up in June, huh?
Yeah. So.
All
The
right.
City College?
The
Would that
state
be
of
off?
California. The state of California generally.
Oh.
So, yeah, and I tell you guys, students, that Bob will be the first one back.
Thank you.
Yeah, he's like, no way.
Yes, because
You
I
know,
live
yeah.
alone, and if I drop dead of COVID, it's less of a loss.
No.
Probably saving a ton of gas, huh?
Vaccinated. No, but what we definitely are planning to do, because it might be too late to get a change in the summer schedule, because everything is out now for online, but like we could like offer optional lectures and definitely could offer on-site tutoring. We can
Yeah, that would be nice.
we will get a bigger classroom, one with outside, like BC 302, Bob, or so, where it's outside, you don't have to go through a building, where you can spread out the chairs and
Oh, yeah.
so we will make it happen, students.
Okay, well, that'd be great. We all get back
Will
on
be
campus. I think everybody's looking forward to that.
Right.
And then I can resume walking and lose some of this weight I put on. It's been a terrible year,
Yeah. So yeah, we put you and outside in the second floor so that you go up and down the stairs.
I have to make
All
multiple
right, guys.
trips. All right,
So
thank you,
my
Cornelia.
Again. Thanks so much. Keep up the good work, guys.
Bye-bye.
Bye.
All right, here we go. Cornelia, I'm not the only one messes up once in a while. My boss sometimes does what I do all the time. Okay, freight. Here's an example again of the freight. Now, let me just back up here. We get the bill and there's the freight charge. It's on the invoice. Here it is again in a different format. We got the bill for $400 and then the freight company billed us directly. So in the first example, we're paying the seller $438. In this example, we're only paying them $400 because what the seller did was call up UPS and said, pick up these goods and deliver them to Newark, New Jersey. Okay. Here's something I think is a little bit new in our class, and we're going to be looking at a more detailed income statement. We're going to be looking at something called gross profit. Gross profit. It's simply this. It's the difference between your net sales and cost of goods sold. Net sales minus cost of goods sold equals gross margin or gross profit. Let me talk a little more about what cost of goods sold is, because I'd like you to all understand this. Cost of goods sold is an expense. It is simply what you paid for the goods you sold. You sold a garment for $1,000. That's your sale. You will debit accounts receivable and credit sales for $1,000. But you paid $600 for that from the wholesaler. Well, in a perpetual system, you're going to be debiting cost of goods sold and crediting the inventory. Okay. So this is kind of the start of our new income statement. Oh my goodness, look at all this now. They're giving us sales and sales returns, discounts, purchases, merchandise inventory. Now we're going to go through a calculation, which is required under the periodic system where we have to count at month end. So they're giving us, if you look at the bottom here, they're giving us what the balance was at the beginning of the year. And now we just went out and counted on New Year's Eve, and we counted $18,000. So how do we work with this? We're going to start by coming up with the net sales. Net sales. Net sales are sales. When you see the word sales, we can kind of guess that they're gross sales, huh? We had sales of 201,000 minus sales returns and allowances minus sales discounts. So your first step is to get the net sales. Now we have to come up with the cost of goods sold. I don't see any cost of goods sold here. That's because we have to calculate it at month end, and I'll spend a little time on that. Compute the goods available to start, okay? We know how to get to net sales. The next step then is we're going to take the beginning inventory plus the cost of goods purchased. Beginning inventory plus what was purchased. And we're going to call that what's available. Your bookstore had 900 books in the beginning inventory. And then you bought another 490. So that's how much was available. You can't sell more than you had. You had 90, in my silly example, you had 90 books at the beginning. You purchased another 410, I guess is what I'm trying to say, to get you to 500. That's the available. And if we go back a page here, what you're going to do is you're going to take that beginning inventory of 26,000. You're going to add the purchases. You're going to subtract the contra purchase accounts, the 800 for returns and allowances, the 800 for discounts, and add in the freight. Add in the freight. At that point, we're going to subtract the ending inventory, and there's our cost of goods sold. It'll look a little clearer in a moment when we see it lined up in paper. Compute the cost of goods sold. The goods available for sale minus the ending inventory equals your cost of goods sold. Goods available for sale minus cost of goods sold equals your ending inventory. So here we go. Gross profit. I am going to assume that you can't read this. Okay? Take a look at this income statement now. Using the numbers that they just provided us, They told us that sales were $201,000, gross sales, if you want to call them that. And we're going to subtract from that returns. People returned $1,200 worth of material. And a lot of our customers took advantage of our generous 2% 10 discount terms. So this is money we're never going to collect. It must be used to reduce the sales to net sales. Net sales. Let me just move this over real quick. Here we go. So they're laying out this income statement kind of nicely, using as many as 5 columns, four columns. Okay, now let's look at the cost of goods sold calculation, please. Cost of goods sold. We start with the beginning inventory. At the beginning of the month, that's all we could have possibly sold. That's all we had. But during the period, we purchased another $105,000 worth of merchandise. We returned $800 and we took advantage of some discounts. Okay. And we add those two contras up and we're going to get something we might call net purchases. We add the freight in. And now we have what we're going to call the cost of goods purchased, or I'm not sure what I want to call that. Net purchases would be fine. So we add the purchases to the beginning, and 129.5 is the most we could have sold. We either sold the 129.5 or we still have some of it. So we count at the end of the period. Let's see, we had 129,500 available to sell. We have not sold 18,000 because we just counted that in the inventory. The difference is your cost of goods sold. And what did we just learn? Sales, net sales, and that's an important word, net sales minus cost of goods sold equals gross profit. Okay? Any questions from anybody? Anybody want to chip in with anything? Going once, going twice. Okay. We just went through the hard part of this chapter, huh? Well, guess what? We have to, just like in chapter 10, we have to post these transactions to the ledger. And just like in chapter 10, where we had an accounts receivable ledger, we're going to have an accounts payable ledger. It's another subsidiary ledger. The general ledger is called the general ledger because it just has basic information. There's no detail. The general ledger is also called the control accounts. So you have a control account, accounts payable, and the orders are going to come in and they're going to look at your balance in accounts payable. It's $1 million. And they're going to say, to whom do you owe this money? And you're going to hand them this report here, the accounts payable ledger. And they'll be able to look at that and select transactions that they want the seller to verify. Accounts payable ledger. Just think of it as a T account for each customer, or in this case, vendor. Now let's take a look at these purchases here. Purchase merchandise terms, purchase merchandise terms. All of these transactions, from what I can see, are the same activity. We're buying something on account. On account, nobody had any money. That's how you remember on account. So I'm going to pop this up. I think you could probably read this easily, but I'm still going to blow it up. Blow it up, I say. So take a look here. The first company was Belinky Cycle Works. We debit purchases, we credit accounts payable, etc. purchases. So basic entry, huh? Purchases, accounts payable, they were all the same. I'm gonna go back real quick. They don't even talk about any sales discounts, huh? Okay. Purchasing, posting to the general ledger. We should know how to post to the general ledger. General ledger. And here it is. I'm gonna continue. Okay. I'm assuming you guys can see the numbers because when I can see them with my bad eyes, you can see them. Please let me know if I'm wrong on that.
No, it's
So-
fine. It's fine.
Good to hear. Thank you. Here we go. We have purchases and accounts payable to post. Well, purchases is a debit to the account. In this case here, it took our balance from 37,400 up to 40,700. And accounts payable, it was $8,100, I guess, before 4,800 before this transaction. So posting to the general ledger, I would not expect to be troublesome, okay? Nor would I expect to be troubled by posting to the accounts payable ledger. It's the same exact thing, except you're doing it for just one vendor, one vendor at a time. Again, you're going to put the date, the amount, the new balance, and you might have a reference number there, a journal page number. So let's see what we have. Again, here is what we just looked at. This is what we just looked at. Here, it's the same kind of thing, except we're going to have one T account, for each of our providers, our vendors. So we have one for Blinky. We didn't owe him anything, and now we owe him 3,300. Ellsworth, we owe him 2,500 now. So this is not too tough, I don't think. Obviously, whenever we touch the world of accounts payable, it must be reflected in this subsidiary. At the end of the month, you add up all the balances of your accounts payable subsidiary, it better equal the general ledger balance, okay? Let's talk about some returns now. Returns. Sunflower Cycle returned $200 worth of merchandise to Rand's Design, huh? We're Sunflower, we returned something. So this has to be posted to the general ledger and to the subsidiary. So $200. Well, that reduces our accounts payable, right? So we know we're going to debit accounts payable, but we also need to know we never credit purchases. So we're going to credit an account called Purchase Returns and Allowances. Take a peek. Here, we return some goods. So we no longer owe this $200. A debit to accounts payable reduces it to 11,700. The credit to purchase and returns and allowances reduces the net purchases. And again, you're going to have one of these ledger T accounts for every vendor you deal with, okay? So we owed this guy $5,300. We returned one item for $200. We only owe him $5,100, okay? Posting cash payments, again, we're getting paid here. So now they're making it a little interesting, huh? Oh, I'm sorry, guys. I got the happy fingers all the time. All right, what happened here? We paid Ace Wheelworks $4,800. All right, that's not so tough. So what do we do here? We debit accounts payable for the 48. We no longer owe them the money, and we give them the cash. Our next vendor rather, Gunner Cycles, he gives us a discount of 1% if we pay it on time. And they're telling us here we did pay it on time. So how much did we owe the man? We owed Gunner $8,700. We don't owe him that anymore. We debit accounts payable to reduce that customer to zero. A 1% discount is $87. And the difference is down here, the $85.87, okay? Not too tough, I don't think. And this time I will blow this up. I can't even see the screen. Would you believe I refereed high school basketball and umpired high school baseball for a long time? If I tried that now, I couldn't see nothing. Okay. They're just showing you the posting to the ledger. We should be good with that. And again, Ace Wheelworks. We owed him $4,800 and now we paid him. This guy, we owed him $87, but we paid him off. And here's the purchase discount account here for $8,787, okay? And now all we have to do now is get the balance from each of these subsidiary ledger accounts, take those balances and put them on a piece of paper. Alphabetical order. Belinsky owes, we owe him 33, we owe Ellsworth 25, etc. There is our accounts payable balance at the end of the month by vendor. That must equal the balance of accounts payable on the general ledger. And again, in the older days, before you had real good computer, fast electronics services, it was very easy to make a mistake because you're doing it in pencil. And at the end of the month, you'd see, well, let's see, Sunflower says per this, our accounts payable is 11,900. And then you look at the general ledger and it's a different number. It's 15,000. And all you can do is go, yike, and then try to dig out what you've done wrong, okay? I'm not gonna go over accounts payable, finding errors. The trick is don't make no errors. Okay, we're not going into this appendix. We're not teaching this, okay? So what do you think, Hunter? Any comments, questions?
Not really, no.
Okay, and where is Bellevue, Washington? That's near Seattle, right? Am I wrong?
Nope, you're right.
Never been up there. Hunter's up in beautiful state of Washington right now. Woo. All right, Hunter, glad to have you here. Hey, Rod, you have any questions, Rodrigo? Any thoughts?
No, all good.
Yeah, this chapter might even be easier than chapter 10, no?
Well, because it tied together, just a
Yeah.
mirror.
Yeah. The only complication here is that lengthy calculation of the cost of goods sold. But
Oh.
if you just think in terms, beginning inventory, we had 100 books. Now we have 300 books. Count what's left over, and then whatever comes out of that is what you sold. So that's good. All right, Ali, I'm going to give you the last word. You want to take over for the next 20 minutes, please?
Yeah, of course. Let's go ahead and go over the appendix then.
No, we're not going to go. We're not taking our appendix out today. But how you doing in this class, Ali? You whizzing through it?
I think I'm doing pretty well.
Good.
I really like it.
Excellent.
The chapters, no, what was the last chapter? Chapter 6 was a little hard for me, but then once we got into chapter 10, it kind of made a little more sense.
Yeah, chapter
And
10
then-
and 11 starts actual business situations. You know what I mean?
Yeah, so
So
it made it
that's-
a little bit easier.
Yeah, I hope so. I think so. No, so you're okay with the what was presented today then, huh? No questions?
No.
Okay, Ali, do you make a motion to close the meeting?
Sure, yeah, I think it's good. I think it's time to go get some snacks.
Okay, I
Okay.
second the motion. Hey, thanks for stopping by, everybody. Apparently I have a 12 o'clock show I come back on the Las Vegas stage in an hour for some reason. All right, you guys take care. Bye-bye.
All right.
You too,
Bye.
thank you.
Thank you.